Part C says, pardon me, says that Chet purchased factory equipment with an invoice price of $75,000 on the 1st of April 2010. Other costs that were incurred at the time of the purchase were freight costs of $1,000, installation and wiring of $2,500, material and labour costs in testing the equipment of $750, oil, lubricants and supplies to be used with the equipment was $300, and fire insurance policy, which was $2,400. The equipment is estimated to have a $10,000 residual value at the end of a 6-year useful life. The company depreciates using the straight line method of depreciation. The company sold the equipment asset on the 30th of June 2014 for $25,000. So you've got a couple of things to do now. We've got 3 things. We've got to determine the acquisition cost of the factory equipment on the 1st of April 2010. It tells me to show my workings. So when we look at this, there'll be some items here that are going to be capital cost and some items that are going to be expense. So let's have a look. Is this going to be a capital cost or an expense? $75,000 invoice price. Capital cost. What about my freight costs? Are they expenses or? No, not in my book, they're not. They're a capital cost. So freight, we need to include everything that would get an asset ready for its use. So if I need to freight it somewhere, that becomes part of my cost of my asset. Installation and wiring, what would you say? Capital. Yeah, capital. Material and labour costs in testing the equipment? Capital.
Oh, but I think this one we can buy the other term, not.
This one did confuse a few people in last year's exam, but it's in getting the machine ready for use. So if I need to test the machine that's working properly, that becomes part of my cost of installation. So it's really part of this bit here. So it's just an extra line. What about oil and lubricants to be used? Expense. And fire insurance policy covering, or insurance policy covering the equipment? It's an expense. All right, so now what we need to do is we need to give out how much our capital cost is worth. So equipment was $75,000. So I'm doing C1. My freight was $1,000. My installation was 2250, and my materials and labour costs in testing, so testing was $750. So the cost of my machine, 76, 78, 79. 79,000. So that's how I finished. So I've determined the cost. It says calculate the depreciation for 2010 and 2011, assuming the financial year ends on the 30th of June. So when did we buy the machine? We purchased on the 1st of April 2010, and we're doing our calculations for the 30th of June. So there'll be 2 bits of calculating to be done here. Now, it's a straight line method. Now our capital cost, now my straight line, my formula for straight line equals cost minus residual divided by my life. Now my cost we worked out to be $79,000 minus my residual. We had a $10,000 residual, so $10,000, and it was going to be useful for 6 years. So that gives me $11,500 as an annual depreciation, and that's annual. But in 2010, I only need to do a couple of months. I'm from April to June, so I've got April, May, June, so I've got only 3 months. So what I need to do is 2010 depreciation is 3 divided by 12 times 11,500 equals, who's fast on a calculator for me? 2875. And then my 2011 depreciation is obviously the full year, so it's 11,500. And that takes care of number 2. Now it says record the journal entry to show the disposal of the asset on the 30th of June 2014. Oops, you're just off the page there. Narrations are not required. So my journal will have a date. Now I need to work out what my accumulated depreciation would be first. So I've got my depreciation for 2010, 2011. I'll need 2012, 2013 and 2014. When did I sell my machine? I disposed of it on the 30th of June 2014. So I'm going to have 4 times 11. So I've got 4 times 11,500 plus 2875. So 4 11's 50, 48, 44, 44, 45 plus 28, 40. So I think I get around about 48,875. Yeah. Okay, so that's my accumulated depreciation. So I need to make that calculation first, because that makes a difference to my journal entry. All right, so let's do my journal entry. I've got a date, I've got a description, and I've got a debit, and I've got a credit. Okay. Now, we already know the cost of my, equipment. So we're on the 30th of the 6th, 14. And what I'm doing is I'm going to get rid of the equipment first. What's the normal balance for an asset? Debit or credit? Now, so if I'm disposing of it, it'll be reducing my asset, so that'll be a credit. My accumulated depreciation, we've already known that. What's the normal balance for accumulated depreciation? Credit. So if I'm reversing it, it'll be a debit. So I've got 48875. Now I've got my sale proceeds. Pardon me. Where's my sale proceeds? It tells me here somewhere, 25,000. So the company sold the equipment for 25,000. That's going to increase my cash at bank. So my cash is 25,000. And now we just need to calculate, did they make a loss or a gain on the sale of an asset? Now this is an easy way to do it. I just got to make sure my debits equal my credits. And the difference will be the loss or the gain. So let's have a look. I've got 60, 73, 73, 8, 75. I've got 79 on this side. So 73 to 79 is 6. So it'll be 5125. So on this side, because then that'll all come back to 79,000, and this will come back to 79,000. Now, if I'm putting a debit in, am I making a loss or a gain on the sale of my asset? Gain, you sure? I'm making a loss on the sale. A gain would be a credit item. So a gain is the same as income, so it'd be like a credit item. And that takes care of number 3.